should they be worried about what's going on in the market right now?
Well,
Depends.
when do they want to access the money? What's their timeline look like? What are they invested in?
Mm-hmm.
Yeah, if you need the money in the next 90 days, then the reality is you should not be invested in the market.
And if you need all of your money within the next 90 days.
Exactly.
Then you need to save more.
Right.
Right. The last thing you want to do is panic, get out. I mean, last year was a perfect example. We had the tariffs kick in, say mid-March. From about March 10th to April 20th, the market went down 16%.
Mm-hmm.
Mm-hmm.
And when we're saying the market, we're talking S&P, NASDAQ,
Right.
Dow.
Right.
Right.
Mm-hmm. Right.
But so again, it is also going to be determined, are you in an index fund? Because if you're not, if you're in a well-diversified portfolio that's not just the S&P 500 index fund, then you might not have as much to worry about as if you're just like, all in indexes.
Right.
So
depending upon the index that you're in.
What do you own?
Mm-hmm.
And don't lose sight of the long-term focus.
Right.
Don't let short-term volatility affect your long-term goals.
Just like a roller coaster ride, the only time you get hurt on the roller coaster is if you're trying to get off in the middle.
Right.
So as long as you know it's going to do this,
Mm-hmm.
hey, I get that, I understand it. As long as you're not having heart palpitations and losing sleep at night, then it's going to be fine.
Mm-hmm.
But back to your point, Marty, I was saying, when do you need to start using these funds?
Mm-hmm.
And it's a matter of just being broadly diversified too.
Right.
Right.
If you're all in the market and you don't have any short-term savings, anything to hedge a downturn, I could understand why you're incredibly nervous.
Right.
Mm-hmm.
But that also means that you know you're taking more risk.
Right.
And if you know you're taking more risk, you also have to have the wherewithal to know it can go down
Right.
just as quick as it can go up.
Right.
Yeah.
Well,
So it's a matter of being diversified in a broad portfolio. And don't make a costly emotional mistake.
Right.
I mean, I've seen it, each of us have been in the industry for 25, 30 years. Collectively, we've got almost 100 years.
Yeah.
So we've seen so
God, we're
many
old.
people.
yeah,
We
you
are.
are.
So we've seen so many people make the mistake of being gung-ho when the market is hot, and they go in and say they're growth investors or they're aggressive investors, and then the moment they lose money, they panic and they sell and they don't get back in, and they say, I lost a bunch of money in the market, I'm never getting back in.
Right.
So
Right.
it really is making sure your emotional tolerance matches what your goals are.
And for people who are considered an accredited investor based on, $200,000 of income last couple of years or $1 million plus in assets, how about we talk about an asset that's not correlated to the stock market, meaning
Absolutely.
it's not going to do the same type of movement that the stock
Not gonna
market
be liquid,
does.
though.
Not going to be liquid, but if you don't need to access this money,
Mhm.
it might be a good idea to look at another investment class.
Right. Well,
to
also,
get
if you're
into it.
concerned about income, then annuities can come into play. So, now I've got guaranteed principal and guaranteed lifetime income, depending upon the same thing, when you intend to use that income
Right.
for it.
But just make sure that you're investing according to your long-term goals, and don't let silly emotional mistakes interfere with throwing you off. We've seen it happen time and time again, unfortunately.